Hey there, financial explorers, and welcome back to the channel. We're diving deep today into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. We screen thousands of equities to find unique situations, and one microcap named Mask has certainly caught our attention due to its extremely high cost to borrow. Is this a ticking time bomb for short sellers, or just a quiet corner of the market? Let's break it down. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/ticker. Today we're spotlighting Mask. Mask is a microcap company, and based on the data we're tracking, its sector is currently N/A. Looking at recent price action, Mask has seen absolutely no movement today, holding steady at a 0.0% change. Over the last 5 days, it's also been flat at 0.0%, and even looking back a full 30 days, we see a 0.0% change. This extreme lack of price movement is mirrored in the volume data. Today's volume is 0 shares. The 30-day average volume is also 0 shares, meaning its relative volume is 0's average. This tells us Mask has been extremely quiet on the trading front recently. Our internal composite squeeze score, which factors in multiple metrics, currently sits at 41.2 out of 100 for Mask. What's cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why should you care? Show graphic. CTB explanation: when an investor wants to short sell a stock, they first need to borrow shares from an existing owner, usually through a broker. Just like renting an apartment, there's a fee involved. That's the cost to borrow. It's typically expressed as an annualized percentage. A higher CTB means it's more expensive to hold a short position. Why does it matter? Because high fees eat into short sellers' potential profits and increase their risk, especially if the stock price doesn't move in their favor quickly. These fees can even exceed 100% annually when demand to short is extremely high and the supply of shares available to borrow is extremely low. Imagine paying nearly 5 times the value of your position just to hold it for a year. Why this stock is hard to borrow right now. Highlight Mask CTB number. Now let's bring it back to Mask. This is where it gets interesting, even with the current lack of trading activity. Mask currently has an annualized cost to borrow fee of a staggering 480.3%. Think about that, over 480%. This indicates an incredibly high demand to short Mask, or more likely, an extreme scarcity of shares available to borrow for shorting. Our data shows that the CTB momentum has been flat at 0 percentage points over the last 5 trading days, meaning these high fees aren't decreasing, keeping constant pressure on any existing short positions. Currently, there are only about 100,000 shares available to borrow for Mask. Considering the estimated float for Mask is a relatively small 0.8 million shares, 100,000 borrowable shares is a very tight supply, further contributing to the sky-high CTB. Squeeze mechanics explained. Show animation of short squeeze. This tight supply and high cost can be a recipe for a short squeeze. In simple terms, a short squeeze happens when a stock's price suddenly climbs, forcing short sellers to buy back shares to limit their losses or meet margin calls. This covering creates more buying pressure, pushing the price even higher, trapping more short sellers in a vicious cycle. The shrinking supply of available shares to borrow, combined with those exorbitant fees we see in Mask, intensifies this pressure. When it becomes too expensive or impossible to maintain their short positions, short sellers are compelled to buy, creating that upward cascade. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock's price will eventually fall, and they are willing to pay a premium to maintain their short positions. Dilution risk check. Show no dilution risk check work. One of the biggest threats to any potential short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can completely negate or offset the buying pressure from short covering, effectively providing short sellers with an out or a fresh supply of shares to borrow. We always check for this. For Mask, we've found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. We also haven't found any recent reverse splits for Mask in our look-back window. This means that, based on our data, Mask is not currently facing dilution risk from recent company actions, which is a positive factor for a potential squeeze scenario. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, with Musk's incredibly high CTB and tight borrowable supply, but zero recent trading activity, what should we be watching? Show watchlist graphic. First and foremost, we need to see if Musk can attract actual trading volume. That zero volume number is critical. A high CTB on zero volume means there's no price movement to trigger a squeeze. We'd want to see volume pick up, indicating renewed investor interest or a potential catalyst. Highlight volume increase. Beyond that, continue monitoring the cost to borrow. Any sustained increase, especially if it breaks above 480.3%, would be significant. Also, watch the shares available to borrow. If that 100,000 number dwindles further, it increases the scarcity factor. Ultimately, for a short squeeze to become a reality for Musk, there needs to be a catalyst that ignites buying pressure and brings liquidity back into the stock. Musk presents a truly unique situation, an extremely high cost to borrow and very limited shares available, yet virtually no recent trading volume or price movement. This dichotomy highlights that while the underlying mechanics for a potential squeeze might exist in theory due to short interest pressure, without market participation and actual trading, a squeeze cannot develop. It's a powerful educational example of how different metrics interact. Remember, doing your own comprehensive research is paramount. If you found this deep dive into Musk and short squeeze mechanics helpful, please hit that like button, subscribe to the channel for more unique stock analysis, and let us know in the comments below what other stocks you'd like us to investigate. Thanks for watching, and we'll see you in the next video.